14 in the Modern Real Estate Practices book. That's the big yellow book.
Yep.
Your PSI book, also, you can match up the topics if you want to in the PSI book and study the PSI book at the same time you're studying the Modern Real Estate Practices book.
At the moment, I'm sticking with the
yellow book? Yeah. Okay. That's a good book. It's a readable book. I think it's a good book.
Yeah, the way that I'm looking at it is if I can get the national, the federal side out of the way first, I can then concentrate on the Colorado.
Right. The PSI book is also the national side.
Yeah, and that's got some tests and stuff in it. So
yep.
Yeah.
Perfect.
Sitting next to me as well.
Okay.
So it keeps me out of mischief. And I've just got to work out how to. I did have this with the three things on top.
So we're going to talk a lot about mortgages today.
Yep.
And so the first question we have is PITI. And
interest, tax, and insurance.
Exactly. These are generally the four most common components to a mortgage payment. We have the principal portion, which reduces how much you owe. We have the interest portion, which pays back the bank for loaning you the money. We have the taxes, which are the property taxes, and those are paid to your local county to support the community. And then we have insurance. The insurance we're talking about here is the homeowner's insurance, and this protects the property from things like theft or fire. Generally, the insurance is going to be required by the mortgage company, and they won't give you a mortgage unless you get it. The property taxes, as we know, are also required, but they're required by the government. And that was one of the four governmental powers. So we talked about four governmental powers. So go ahead and write that down, four governmental powers, and write down the word Pete. And the four governmental powers are police power, which is like zoning and building codes.
Yep.
Eminent domain is the right to buy your property at fair market value for a public good.
Taxation.
And then process a condemnation for that.
Yep.
The third one is taxation.
Yeah, and then the last one
about here is one of the four elements of the mortgage payment. And the last one is escheat. Escheat, E-S-C-H-E-A-T.
Yep.
Is when the government gets your property because you die intestate, meaning without a will, and you have no heirs.
Yep.
These funds, the principal, interest, taxes, and insurance, are collected monthly and placed in an escrow account. The funds here are taxes and insurance. They are placed into an escrow account by the lender, so the lender can pay your property taxes and insurance bills. So what they do is they collect the property taxes for the whole year, and then they pay them at the beginning of the next year for the previous year, because property taxes are in arrears. It's just the opposite with insurance. They collect in advance for insurance, and then they pay in advance on insurance. So 2021 insurance is paid in January of 2021.
Yeah.
Whereas January of 2021, we're paying 2020 property taxes. That's
correct. Yep.
And then there's a federal law called RESPA. So write this down, R-E-S-P-A. And RESPA governs a couple of really important things. One is they make sure that the mortgage companies aren't collecting too much money from borrowers for taxes and insurance. And then RESPA also doesn't allow real estate licensees to get kickbacks from title companies and mortgage companies for referring business to title companies and mortgage companies.
Unless the mortgage company is at least owned by one, at least the ownership is greater than 1%.
That's right. So if your real estate brokerage has an affiliated business arrangement with a mortgage company or a title company so that they form a third entity, then you can refer your clients to that mortgage company or that title company, as long as you disclose to them that your real estate brokerage is a partner in the business.
Yeah.
Okay. Now we're talking about loan to value. Loan to value is the percentage you're borrowing as a percentage of the total sales price.
Yep.
So if the sales price is 500,000 and you put down 50,000, which is 10%, then your loan to value is 90%.
Yep.
Okay. Usury is just a vocabulary term, which means that you're charging an interest rate beyond the legal limits.
There used to be a company in the UK called Wonga, and it was a payday lender.
Yes.
They were charging 4,700%.
Yes. Yeah.
So, yeah.
Yeah, that's just horrible stuff. And so usury is the act of charging an interest rate above the legal limits. And we're going to talk about that. And when you charge an interest rate above the legal limits, they call that predatory lending. That's the term they use, predatory lending. And then we have something called discount points. Are you familiar with discount points, Tim?
I am in investing.
In what?
Investing. So
Okay.
A discount point is 1%.
Good. And tell me how it works.
So basically, if you are, let's say I get a line of credit with the bank, they give me a 1.5 discount point. I'm paying 1.5% over and above what the base rate is.
Good. Yeah, that's what we got going on here. It's when you pay over and above. And in this case, you pay extra at the time you get the loan in order to get a lower interest rate. So you could buy 4 discount points to lower the interest rate by 1 percentage point, for instance. So if a discount point costs 1% of the loan amount, and it takes 4 of those to lower it from a 3% loan to a 2% loan, then you bought 4 discount points to lower the interest rate by 1%.
Yep.
Did you get that, or would you like me to say it again?
No, I've got that. So it's
okay.
It's
now, when interest rates were at 9% back in 1997, I used to ask sellers to buy 3 discount points to lower the interest rate for my buyers.
Okay.
Now, the sellers were so anxious to sell their house, they were willing to pay the buyer's discount points so the buyer could get a lower interest rate, and therefore the buyer would be able to buy their home. So it's a negotiated item. And that's something you talk with your seller about up front.
Okay.
In today's market, interest rates are so low that buying discount points doesn't make sense. And discount points is said to be prepaid interest. And what they mean by that is because you're paying the bank in advance at the very beginning of the transaction additional money to lower the interest rate, it's the same function as if you're paying them interest in advance.
Okay.
And so they say discount points are prepaid interest. An interesting thing about discount points is regardless of who buys the discount points, they're a tax deduction for the buyer.
Yep.
So I used to have my seller buy them, and my buyer would get the tax deduction and the lower interest rate.
Yep.
So that was a really sweet deal for the buyers. Discount points increase the lender's yield. So because they're getting the interest up front, know that it's increasing their yield.
Okay.
What are some of the tax deductions buyers receive for buying a house?
With a mortgage, they can actually allocate the interest or report the interest on their 1080,
Yep,
which they can then use to lower the taxes that they're going to be paying.
that's right. So that's by far the biggest one, is the interest. And we know on a normal amortized loan, interest could be 2 or 3 times the sales price over the life of the loan. So on a $500,000 home, interest could be $1 million over 30 years.
Mm-hmm.
It could be an awful lot of money. Big tax deduction for buyers.
Okay.
Another tax deduction for buyers is property taxes. So as they're paying their property taxes every year, they can also write that against their gross income to affect their, to make a lower adjusted gross income.
Right.
A third one is loan origination fees. In order to get a loan, we generally meet with a loan originator, and the loan originator typically charges about 1% of the loan amount as his or her fee. So the loan origination fee is also a tax deduction. Loan discount points are a tax deduction like we just talked about. And if there's any loan prepayment penalties, those would be a tax deduction. Loan prepayment penalties for residential mortgages has pretty much gone away. The federal government has said loan prepayment penalties for residential properties is predatory lending, but you still find loan prepayment penalties for commercial lending.
Okay. And that's basically when you can pay your mortgage off early.
Yes, and that happens, could be, that happens all the time. Because you get a 30-year mortgage, but then you move in 10 years. So you end up paying off your mortgage early because you sell the house.
Okay, and I've got a question on that actually.
Sure.
Hang on a second, I'm just writing this down. So in the UK, if you have a mortgage on your property and you sell your property and buy another property, you can usually take your mortgage with you to the new property.
Wow. We don't do that at all here.
No?
No. I've never heard of such a thing.
I mean, it's just, it makes things so much easier.
Yeah, it makes good sense. It's really interesting. I've never heard of such a thing. Now, the only thing I would think about, Tim, is if you're moving up, well, your collateral's going to change, right? The home.
Yep.
And so I find that interesting because homes are going to have different values.
That they will, but because you've already got the mortgage and you've built up your credit with the lender.
Yeah. Wow.
They then literally just look at it and say, okay, how much are you earning? How much is the new house worth? How much more do we need to put onto your mortgage? And it's a done deal.
Wow. Yeah, we don't do that at all here.
Okay.
That's really fascinating.
I'll have to have a word with some banks and start it up.
Yeah. So mortgage documents. There's 2 mortgage documents. There's a promissory note, and that talks about the interest rate, the payment, and the number of payments.
Yep.
Okay. And then there's the second document, which is either called the mortgage or it's called the deed of trust.
Which we have.
Different states will either be a mortgage state or a deed of trust state. The difference is a mortgage state is where you're going to have foreclosure determined by a judge, and the two parties to the mortgage are the lender and the borrower, the bank and the buyer. That's a mortgage.
Yep.
Colorado's a deed of trust state. So we don't have foreclosures by a judge. We have administrative foreclosures. And we have three parties. Just like any trust, there's going to be three parties: a trustor, a trustee, and a beneficiary. The beneficiary is the bank, the trustor is the borrower, and the trustee, the person in the middle, is a public official called the public trustee. And it's that public official who does the foreclosing. And they're the ones who are there to make sure that the trustor isn't taken advantage of by the beneficiary.
Okay, and that's usually the
Bank.
no, the trustee would be the county records officer.
Yes, it's that nice lady who works for the county.
Okay.
So it's an administrative position in your local county, and it's called a public trustee.
Okay.
And she's the one who's managing the foreclosure process, and she's the one who starts the foreclosure process if the bank, the beneficiary, tells her that the trustor has stopped paying. And she follows the state guidelines. So the state gets to set out the rules for foreclosure, which make it advantageous to the trustor.
Yep.
Because they're rules set by the government. So
Yep.
to know that the two documents for a loan are the promissory note is one, and either the mortgage is two or the deed of trust is two, depending on the state.
And does it matter which order they're signed in? Because I would have imagined that the promissory note would have been signed prior to the mortgage.
No, they're signed at the same, at the same time, but it doesn't matter which one comes immediately before the other.
Okay.
I've never heard that it would, but they're both signed like back to back.
Right.
Okay. So in a two-party state, we have the mortgagor and the mortgagee, the borrower and the lender. Okay, that's a two-party state. Colorado's a three-party state. So we do a deed of trust instead of a mortgage. So Colorado is a three-party state, not a two-party state. Okay.
Yep.
Who retains title when the borrower gets a mortgage? The borrower retains both legal and equitable title to the property that serves as the security for the debt. The mortgage, which is the mortgage on the property. So Tim, what I'm saying here is, when you get a mortgage, the borrower gets both legal and equitable title. The mortgage company, all they get is a lien, and all they have is a right to foreclose.
Okay.
They don't have ownership. They just have a right to foreclose if you don't pay them.
Right.
Many people like to say, I don't own this house, the bank owns the house. That's not true, but I think they don't mean it to be true. They're just making a sentiment because they're just tired of paying the bank every month so much money that they don't feel like they own it. Legally, they own it. and the bank just has a right to foreclose if they don't pay.
So it's basically the mortgagor has clear title to the property, but there is a lien on the property for the value of the loan.
Yes.
Okay.
And now we're talking about the three-party state. So this is what Colorado is. We're a three-party state. And so we have the trustor, the trustee, and the beneficiary. So the beneficiary is the lender, and the lender gives the trustor money. Okay? And then the trustor gets ownership of the property, and the trustor gives the lender a note, a promise to pay. And then the trustor deposits the deed of trust with the public trustee, and she holds that deed of trust. Okay? Really, she holds it for the benefit of the beneficiary. And then when the money's repaid, the trustor, you can see, repays the bank. And then once that's done, then the deed of trust is released back to the trustor. And that's called a reconveyance deed. When they reconveyance, a deed of reconveyance, when they give it back to the trustor. So
the deed of trust actually contains the deed of the property.
Yeah, it's a collection of rights to the property. Okay. But it's not the actual ownership deed, because that's going to be what we call that, not the general warranty deed, but the, starts with an S. I can't believe.
Oh God. Fee simple.
No, that's not what I was looking for. Okay. No, okay, so this is a three-party system that we belong in. Now, written in the deed of trust or written in the mortgage document are going to be a variety of clauses. So go ahead and look at these three clauses.
Okay.
The acceleration clause allows the lender, assists the lender when the borrower defaults. It gives the lender the right to declare the entire principal balance due and payable immediately. So the acceleration clause would say, okay, borrower, you're now 75 days late. Instead of just paying back the 75 days, now the entire amount is due. So the acceleration clause has a trigger date like that to it, where the whole amount is due. It accelerates the whole amount.
Yep.
And it might be 75 days, 90 days, 120 days. The alienation clause is called the due on sale clause. And so we've seen the word alienation before, where we saw voluntary alienation and involuntary alienation. And in this case, alienation just means the sale. So this is the sale clause. And it says when the property is sold, the lender may either declare the entire principal balance due immediately or permit the buyer to assume the loan at an interest rate acceptable to the lender. Now, assumptions are really uncommon, okay? We almost never see them. Like 1 in 1,000 loans would you see a new buyer assuming a previous seller's loan.
Yeah.
It's super rare. Okay. So the alienation clause is the sale clause, and it says when the property's due, the lender's due is money.
Yep.
So I can't sell my house to you, but then continue to pay the lender over my 30-year payment cycle, you know.
Yeah,
He
because
wants the whole amount due because I just sold the property.
and the new buyer may also have a mortgage, at which point that company has got a lien on the property.
I was thinking about it as the seller, I have a mortgage, and in my mortgage is an alienation clause. So
Okay.
I'm the seller and I'm selling my house and there's a mortgage on it or a deed of trust. And I sell my house to you, Tim, and you pay cash. Okay.
Yep.
You pay me 500,000. The alienation clause in my mortgage says, because I sold my house to you, I have to pay off my mortgage.
Okay.
Whereas if the alienation clause wasn't in there, I could take that 500,000 and I could just keep paying off my mortgage over the next 25 years.
Yep.
Okay. And then the power of sale clause is in deed of trust states, and it allows for non-judicial foreclosure by a public trustee. So the power of sale clause is the clause that gives the public trustee the right to sell the property if the trustor, which is the borrower, stops making payments to the beneficiary, which is the bank. So if I stop making payments to the bank notifies the public trustee. The public trustee gives me a notice that they're going to foreclose, and then they foreclose, and then they sell my house, and then they give that money to the bank. Does that make sense?
Yep. Even if more than you borrowed.
Even if what?
Even if it is more than you have borrowed.
Now, if it's more than I borrowed, what they do is they pay the bank off in full and I get the extra.
Okay.
If it's less than what I owe, they give the bank everything, and then the bank will go talk to a judge, and the judge will give the bank a judgment lien against me personally.
Okay.
What is an assumption mortgage?
When you assume the mortgage that is already on the property.
Mm-hmm. It's an assumption mortgage is when the buyer assumes the existing loan on the house from the seller. The seller must be assured by his lender that he is released from the loan. So it'll be really important. Now we're talking about two types of loans here. The first one is known as a balloon payment loan, and the second one is known as a straight loan. So the first thing we want to talk about here is amortized. And do you know what amortized is by chance, Tim?
It's basically something to do with death. It's basically how the interest is calculated. I've lost you.
Yeah, that's fine. Sorry about that, Tim. One quick second. Oh, there we go. So, and you're right. Amortized means death, and it's a type of loan where the loan amount is slowly killed off a piece at a time over an extended period of time. Most loans are, you know, for a house are 30 years. They're a 30-year amortization. Mm-hmm. That means every single month, another piece, a gradually increasing piece of the house gets paid off. A gradually increasing piece of what you owe on the house gets paid off. So your first piece, you're paying back $200 of what you borrowed. The next month, you're paying back $205 against what you borrowed. The third month, $210. The fourth month, $225.
Yep.
So amortized means over 360 months, you kill off what you borrowed. So if you borrowed 450,000, then you pay a piece of that over 360 months. 360 months is 30 years. And that's what an amortized loan is. All of our mortgages are typically amortized loans.
Okay.
Okay, good. Now, and most loans are 30 years. And 30 years means there are 360 payments. Does that make sense?
Yes.
Okay.
12 times 30.
Yes. So, and if it's a fixed rate loan, Tim, that means the interest rate is fixed and it never goes up or down. If it's a fixed rate at 6%, then the bank's going to make 6% on year 1 and on year 30.
Yep.
Does that make sense?
Yep.
Okay. Now, the difference is on year 1, they'll make more money on interest than they will on year 30 because it's amortized. Okay?
Because you've built up the principal that you've borrowed, basically, and
yes.
more money from your monthly payments goes to paying off the principal rather than the interest.
Exactly. And you would think it would be like a bell curve. So you would think halfway through the 360 payments, you'd be at equal portion principal and equal portion interest. You're not. Not till month 240 are you at equal.
I'm just looking at my spreadsheet.
Yep.
Because my way of dealing with these things is to actually put it into if I can write a spreadsheet for it, I understand it. So I wrote
That's good. Yeah, and so I don't know if you have an amortization spreadsheet in front of you, but you should probably see payment 240 is when the interest and the principal would finally be the same.
240. So 240. Oh, hang on a second. I've got a mistake here. Oh no, sorry, 240. I've got it sort of roughly equal at
okay.
Payment 242.
Okay. Okay, so that's what amortized means. And that's what's really common. And what's also is really common is fixed rate versus adjustable rate mortgage. Adjustable rate mortgage is when the interest rate can vary according to what's going on in the market. So if you get an adjustable rate mortgage and it's currently at 6, that means it could be 7, 8, 9, or 10, or it could even go the other way, 5, 4, 3, 2, although it never seems to go the other way.
No.
So with low interest rates now, it's almost always fixed. Bless you.
Sorry.
The next thing I want to share with you is now balloon payment. So this is not very common in residential, it's common in commercial. And this says, I'm going to give you a 30-year amortized loan, but it's going to be due in 7 years. Okay, so it's not amortized over 7 years. No, it's amortized over 30 years, but then you just go to your principal balance on payment number 84, and that's your payoff.
Okay.
Which is going to be almost no principal.
Yep.
So a balloon payment loan sounds like something like this. 30-year amortized, balloon payment in 7 years. And on that 84th payment, you pay off everything you owe. Okay. And the reason you would do that is like if you knew you're going to come into money in 5 years, then maybe this would be a more attractive loan for a bank, because then they know the risk ends for them in 7 years.
Okay.
Okay. So that's a balloon payment loan. You have that big principal balloon due like on year 7.
And that's agreed at the beginning.
Pardon?
That's all agreed.
Yes, absolutely. And, and I've done one of these before, but it was on a commercial property and it was, amortized over 30 years, but balloon payment at the end of 7 years.
Okay.
And so that gave me 7 years in my mind to have low payments and give me an opportunity to save up money to pay off the entire amount owed on payment number 84. Okay. Now, a straight loan is the same thing as a term loan, which is the same thing as an interest-only loan. So write down straight loan equals term loan equals interest-only loan. I'm used to calling straight loans interest-only loans. An interest-only loan is if I borrow $450,000 from the bank, and at 6%, then do you think you could figure out what my monthly payment would be, Tim?
So, sorry,
400. I'll grab a calculator too.
450,000, 6% over 30 years.
Yep.
It would be $2,697.98.
How much did you say?
$2,697.98.
And how did you do that?
I've got that on my spreadsheet.
Okay. And what type of loan is that?
That is an amortized loan.
Right. What was that amount per month again?
2,697.98.
So 2,000, I'm going to round $2,698 per month.
Yeah.
Now, that's an amortized loan at 6%. Okay.
Yeah.
A straight loan is when you're paying interest only.
Okay.
So the interest only payment is $2,250 per month. So if you were considering an interest only loan or an amortized loan, that would be your choice. You could say, I'm going to pay the bank $2,250 a month on an interest only loan, or I'm going to pay the bank $2,698 on an amortized loan.
Okay. So
what's the advantage of both of these?
Well, the advantage of the amortized loan is you're actually reducing your capital, your principal that you've borrowed. The downside is you've got less cash in your pocket at the end of every month.
Exactly. So,
but the straight loan, the problem with that is, are you actually going to have enough saved up to actually pay it all off at the end? So in England, we had a thing called an endowment policy that you had to take out if you took out a interest-only loan.
Okay, what's that?
So an endowment policy it was an investment policy that you pay on a monthly basis, with the idea being that an actuary would actually work out how much that would be worth at the end of that period, so that there would be enough in there plus a bit extra so that it would pay off your mortgage, and then you get cash kickback as well.
Perfect. Good. So with the straight loan, after 30 years of paying $2,250 per month, you still owe the whole $450,000. On an amortized loan of paying $2,698 a month, at the end of the 30 years, it's paid off.
Yep.
Now we're going to talk about two more types of mortgages. There's one called a growing equity mortgage and an adjustable rate mortgage. So an adjustable rate mortgage is an ARM. A growing equity mortgage is called a GEM. Both of these will have fluctuating payment amounts. So each month the payment amount could vary. A growing equity mortgage, it'll change because how much you're paying on the equity or the principal portion will change. Whereas an adjustable rate mortgage, how much you pay on interest could change because interest rates will have the right to go up and down depending on the market.
Okay.
So I've never run into a growing equity mortgage. So for the purpose of understanding these two types of loans on kind of a basic level, you just need to know that growing equity mortgage, the payment will change because the principal portion will change. On an adjustable rate mortgage, the payment will change because of the interest rate will change.
Yep.
Okay, scenario number one. You're going to need a regular calculator for this. This is not this is an illustration of amortization, but it's not an actual amortization. Okay, Tim?
Yep.
Okay, so let's pretend that you're borrowing $350,000 and you're amortizing it, and the interest rate is 6%. And the principal and interest payment is $1,900.
Six. That's 21,000 per annum.
Perfect.
Divided by 12, so that's 1,750 per month, which leaves 150.
Perfect. Good. You're right there. So what you did, I heard you do it, is you have the principal amount, you multiplied it by 6% annual interest, and that got you to the $21,000 in interest. $21,000 in interest divided by 12 months gave you $1,750 in interest. The question told you that your principal and interest was $1,900. Therefore, principal and interest minus interest leaves you just principal. And now it's your principal payment is $150. Your interest payment is $1,750, and therefore your principal and interest payment is $1,950.
Yep.
Make sense? Now,
yep.
This is the way amortization works. So however much, and here's the illustration for payment number 3. So if we figure out payment number 1, we figured out 150 went to principal. Therefore, for payment number 2, the principal portion was $349,850 instead of $350.
Yep.
The principal went down. Multiply that by 6% annual interest, and you got $20,991 for your annual interest, divided by 12, and now you have $1,749.25 for your monthly interest. Your payment is still the same because it's amortized, and your principal and interest is still $1,900 minus your interest, and now your principal increased. And it increased by a whopping 75 cents. Exactly. Yep. Now you have your principal, and you subtract that from the previous principal, and now you have your new principal balance. times 6% gives you your annual interest, divided by 12 gives you your monthly interest, principal interest minus interest, and now your answer for your principal portion on payment 3 is $151.50.
Yep.
Very good. So I think the key here for people is understanding you want to figure out how much you're paying per year in interest. And all you have to do is how much did you borrow times your interest rate. So 350,000 times 0.06 tells you your interest for the year is $21,000. $21,000 is your interest for the year. That's an awful lot of money going straight to the bank. And then you divide that by 12 and your monthly interest is $1,750. The good thing is, even though the bank's getting this $21,000, that's a tax deduction. It lowers your tax liability. The bad news is that money's going to somebody else. Foreclosure. So mortgages foreclose through courts. So when I said there were two types of states, I said there were mortgage states and I said there were deed of trust states. In a mortgage state, they foreclose through a court, and that's called a judicial foreclosure. If you foreclose through a judge, that's a judicial foreclosure. In Colorado, we're a deed of trust state. We have non-judicial foreclosures, or also known as administrative foreclosures. In Colorado, it's actually the deed of trust, it's the public trustee who forecloses on the property. Does that make sense? Okay. Now, something different than foreclosure is called a deed in lieu of foreclosure. This is when you know you've hit a hard place in your life and you can't continue to make your mortgage payments. So you get a hold of the bank and you say, bank, I want to give you the deed back to the property, and that way you won't have to foreclose. And the bank takes the deed back, thereby taking the ownership back, and then the buyer, the borrower, is released from their obligation. That's called a deed in lieu of foreclosure, and it'd be an agreement. So a deed in lieu of foreclosure agreement. Now,
and then I presume you notify the trustee that this is what you've done.
yes.
So they then release you from everything as well.
That's right. And it would be the beneficiary that would tell the trustee that. And it'd be the beneficiary that would give the trustee directions, written directions to release the deed.
Okay.
Now, when we have a foreclosure, there's said to be an equitable redemption period, and there's said to be a statutory redemption period. So these are two more vocabulary terms. An equitable redemption period comes first, and the statutory redemption period comes second. The equitable redemption period gives the borrower a grace period before they get foreclosed on, and they only have to pay payments and fees. So the equitable redemption period gives the borrower a grace period where they only have to pay payments and fees. Whereas the statutory redemption period, once you've crossed into that, then the acceleration clause kicks in and you have to pay the entire amount back.
And if the equitable redemption period, they get to the point where they're back square with the lender.
Exactly.
Does foreclosure still occur, or?
No. Okay. It's just a matter of being late. And then they've cured that they've cured their default.
Right.
In the real estate financing market, there are three players. We have the Federal Reserve, the primary mortgage market, and the secondary mortgage market. So the Federal Reserve is a group of banks and it's a quasi-governmental institution, and there's 12 of them in the country, and they set the lending rate, known as the discount rate, between banks. And by setting the discount rate, they set the interest rate. Because if banks know what they're going to charge each other, then banks know what they're going to charge the public.
Yep.
So by setting the interest rate, they control the market. And right now we have a really low interest rate, and that's what keeps this market afloat, and maybe even a little artificially afloat. And yep. The Colorado market has seen such escalation in value that if interest rates went up, the market would go silent. So if interest rates went up 3, 4, 5%, then people could not afford homes. And then we might see sellers paying discount points for buyers.
Okay.
The other part of what the Federal Reserve does, known as the Fed, is they control the reserve requirements of banks. Reserve requirements are how much banks are required to keep on their books and do not have available to lend out. If the Federal Reserve wants to slow down the economy, they'll increase the reserve requirements, requiring banks to hold more money instead of releasing more money into the marketplace for more loans. So if the Federal Reserve wants to slow things down because inflation's going too fast, they'll increase the reserve requirements, thereby forcing banks to have less money to loan out.
Mm-hmm.
Okay? And that's if they want to do the opposite, if they want to stimulate the economy, the Federal Reserve will say, okay, banks, you can hold less money on your books, and you can loan out more money and stimulate the economy, and you'll have more money to loan to people through the primary mortgage market. The problem is, if they don't have enough money on their books and there's a run on the bank, then banks could go default, and then the federal government, through FDIC, Federal Deposit Insurance Corporation, has to backfill the banks.
Yeah.
Okay, so that's the Federal Reserve, and we hear about them all the time lowering or increasing interest rates. The primary mortgage market is where home buyers go for money. So this is Wells Fargo, First Bank, Chase, Quicken, any place they can go for money is the primary mortgage market. And the secondary mortgage market are the three entities that buy all the loans from the primary mortgage market, thereby giving them more money to make more loans.
Yep.
And these three entities are Ginnie Mae, Freddie Mac, and Fannie Mae. And we'll cover those in just a second. So the institutions that make up the primary mortgage market. For test purposes, please look at all these institutions and know that they're part of the primary mortgage market. Thrifts, savings associations, commercial banks, insurance companies, credit unions, pension funds, endowment funds, investment group financing, and mortgage banking companies. All of these entities could make mortgages to the public. Although the public generally just thinks about commercial banks or savings and loans or credit unions. That's who we generally think about when we want to get a home mortgage. But all of those are in the primary mortgage market. And I ask you to get familiar with all those because you'll see a multiple choice question. And I want you to know that an endowment fund is part of the primary mortgage market, even though my mind would never go there on its own. What institutions make up the secondary mortgage market? So this is where we have Fannie Mae, Ginnie Mae, and Freddie Mac. And Fannie Mae is the Federal National Mortgage Association, I think. And this is the Government National Mortgage Association and Federal Housing Loan. I should look those up. But Fannie Mae is for conventional FHA and VA loans. Ginnie Mae is for FHA and VA, and Freddie Mac is mostly conventional.
I thought Freddie Mac was more commercial.
Freddie Mac?
Yeah.
Yes.
Okay.
And these three entities, they used to be quasi-governmental, but then after 2008, they were actually absorbed by the federal government. So now they're governed, so they are now government institutions. And they'll buy up the loans in like big buckets of 1,000 loans at a time. And so when they buy those loans, that money that they buy them from the primary mortgage market, and that money goes back to the primary mortgage market. And then the primary mortgage market can lend more money. So the primary mortgage market is really in that cycle of make loans, sell loans, make loans, sell loans, make loans, sell loans. And that's what they do. And what they sell into the secondary mortgage market for is how they make money. So they make money in originating, and then they make money in selling the loans.
Okay, I've actually on that. So let's say the Fannie Mae is my mortgage. Who do I then pay?
Okay, so there's another player involved in here, and that's called loan servicing companies. So Fannie Mae will buy it, and then they'll hire someone like Chase or another bank to be the face of that loan and to service the loan through the public.
Okay, so if I got my mortgage through, let's say, Wells Fargo,
Yes.
and then Wells Fargo then sell my mortgage on the secondary market to Fannie.
Yes.
And Fannie Mae say, well, we're going to have Chase
service
that loan. Do I then pay Chase, or
yes.
do I keep paying?
No, you'd pay Chase.
Okay.
And Chase would just act as a flow through for Fannie Mae.
Right. Okay.
Kind of like the way, almost like the way, a property manager represents the landlord almost.
Okay.
What is an FHA loan? What is a VA loan? The Federal Housing Administration, FHA, operates under HUD, which is the Housing and Urban Development. Housing and Urban Development. HUD is a department of the federal government. It doesn't lend money. It insures loans, providing extra security for a lender in the event the borrower defaults. FHA acts more like an insurance company and usually requires 3.5% down. So without FHA loans, most loans would only happen with 20% down. But now because of FHA,
Sorry.
Much better. Now, because of with FHA, we're able to get a home with as little as 3.5% down. If it weren't for FHA, regular conventional financing is 20% down. So if I put down 20%, Tim, what would be my loan to value?
Well, it'd be, your loan to value would be 80%.
Exactly. Good. Thank you. Now, if I put down 3.5%, what's my loan to value?
96.5%.
Yep, 96.5. So we're used to feeling pretty entitled that banks would give us a loan with only 3.5% down. And they're taking, 96.5% of the risk. And we sort of feel like that's the way it should be. But I think we're just a little spoiled that way. And we're a little spoiled that way because, we've developed the FHA program. Now, the VA program is even better. And this is based upon if you have veteran status. And then because you're a veteran, they're going to allow you to buy a home with 0 down. You still have to prove your credit and your income, but you don't have to come up with a down payment. And I like that program. I think it's a great program. And I like rewarding veterans this way. But it's a really good program for veterans.
I was going to say, we've got something like that in the UK.
They don't have it?
Nope.
Oh, wow. Yeah, it's really good. It is really cool. And you know what? Do you know what mortgage insurance is, Tim?
It basically, it's the buyer takes out mortgage insurance to protect the lender.
Yes. And in an FHA loan, it's built into that transaction. And with a VA loan, there's much less mortgage insurance. If there's no monthly mortgage insurance with a VA loan, so it's even more affordable. There is an upfront mortgage insurance, but there's not a monthly mortgage insurance. So a VA loan's a great way to go. And then if you're a real estate agent and you're a veteran, you could get into a house with 0 down and collect a commission and walk away receiving money for buying a house. So that's a pretty good deal.
Okay.
Okay, 2 more types of loans I want to talk about: a package loan and a blanket loan. So a package loan is when you're buying a property that has both real and personal property. So Tim, what's personal property?
Personal property, in this instance, it would be like furniture.
Good. And what's real property?
Real property is something that has a bundle of rights. It's the soil and all the actual things that are bolted to the earth and a bundle of rights. Perfect.
Most lenders only want to make a loan against the real property. But in some cases, especially like in tourist areas, like in Vail or Aspen or Hawaii, when you buy a property, it comes fully loaded with furniture. If it's like a resort property. And in that case, the lender would give you a package loan, a loan that covers the cost of the personal property as well as the real property.
Okay.
Otherwise, in traditional residential real estate, lenders start to get really nervous if they see in the contract to buy and sell that there's a lot of personal property coming with the transaction. They expect some personal property to come with the property, but they don't want to see that the Corvette in the garage is part of the deal. Okay. And if they do, then they're going to balk. And then you're going to have to try to find a lender that would do a package loan.
Okay.
Now, another type of loan that I've seen is called a blanket loan. this is where you get a loan for more than one property at the same time. So I worked with some lenders and they were buying multiple properties in a subdivision. So they would buy maybe 4 home lots at the same time. So that was 4 distinct properties with 4 distinct legal descriptions. And then they were going to build a house on those lots and sell those houses individually. So they went to their local bank and they got a blanket loan where they bought the 4 properties, the 4 lots in one loan. And that's called a blanket loan. So it's when you buy more than one property with one loan.
And that also applies to developers of a subdivision.
What's that?
That also applies to developers in a subdivision.
Yes, although it just depends with developers, because developers might be getting a really big loan. It might just be one property that's really big that they're buying, as opposed to 4 or multiple properties. Or a developer, the way I see developers work, they'll go out and buy 40 acres and that'd be one property. And then they'll take it through what's called the entitlement process. And then they'll turn those 40 acres into 100 different distinct properties with 100 different legal descriptions and 100 different home sites. But then, so that's what they had, was one loan on one big property. Okay, Truth in Lending Act and Regulation Z. So this is, whenever we see the word act, bless you, whenever we see the word act, we know that means it's a law. And Regulation Z is a regulation within the act, or a regulation as a result of the act, which provides how things are going to be operated. So Truth in Lending Act requires creditors to disclose the true cost of interest, including loan fees, finder fees, service charges, and discount points. So it's really the true cost of lending. It creates a new percentage called the APR, the annual percentage rate. So when you get a loan, you'll get a loan at 6%. But if you were shopping the lender would have to advertise that that APR for that loan is 6.5%. Yeah. That extra 0.5 is the how much they're going to make on things like loan fees, finder fees, service charges, and discount points. Yeah. It represents how they're going to make additional money from you in additional to the interest rate. The interest rate is what you pay on every single month. The APR is what you pay overall, because you're also paying upfront fees called the loan origination fee, service fees, and discount points. Does that make sense? Yep. So Tim, if I was shopping 2 lenders and I'm looking in the newspaper and I see Joe's Lending Shop has an interest rate of 5% and an APR of 5.25%. And then I see Mary's Magical Mortgage Company, and she's got an interest rate of 5% and an APR of 5.5%. Should I get the mortgage from Mary or from Joe?
I would go and get the one from Joe.
Why from Joe?
Because his overheads are smaller, so therefore the APR, the running costs of the loan are lower.
Good. Yes, I agree. Joe's the better deal. Joe has the lower interest rate. Now, for the high level question, your monthly payment. So your monthly payment with Joe from the loan you got from Joe and the monthly payment you got from Mary, which one is going to have the higher monthly payment?
Well, Mary's would be the higher monthly payment.
And this is where I got you. They would have the same monthly payment because they both had an interest rate of 5%.
Okay.
The difference is you would have paid Mary more to get the loan.
Okay.
Or in this case, you paid Joe less to get the loan. However, after closing, it wouldn't matter because your payment's going to be the same whether it's Mary or Joe who helped you get the loan.
Yep.
Okay. Yep, a little bit of a trick question there. Regulation Z is the regulation on advertising the lender's credit terms. Lenders are now required to use APR rather than interest rate. The interest rate of the loan and the APR is the true interest rate. So we like to say the APR is the true interest rate only because it takes into account the fees. But we know it's the number created once you take into account the fees. Regulation Z was enacted by the Federal Reserve to enforce truth in lending. Truth in lending, known as TILA, also defines a creditor as someone who extends consumer credit more than 25 times a year or 5 times a year for a home. Okay, so TILA defines a creditor as someone who loans money more than 25 times a year or lends money on a home more than 5 times a year.
Okay.
And that's going to be important when we start to talk about usury again. Because if they're a creditor because they meet this criteria, then they have to follow the usury laws. If they're not a creditor because they don't follow this criteria, then they don't have to follow the usury laws. What is the Federal Equal Credit Opportunity Act? ECOA prevents discrimination in lending regardless of race, color, religion, national origin, sex, marital status, age, and dependence on public assistance. So ECOA is the Federal Equal Credit Opportunity Act. And so if I'm 80 years old and I want to get a 30-year loan, it would be a violation of ECOA to deny me a loan because I was 80. If my credit was fine, if my income was fine, if my reserves were fine, if my FICO score was fine, they could not deny me the loan because of my age.
Okay.
What is the Community Reinvestment Act of 1977? CRA requires lending institutions to collect and reinvest in their community as established by geographic boundaries. So if you're going to set up a bank in this area, then you have to reinvest in the community. The big one here is RESPA, the Federal Real Estate Settlement Procedures Act. When you write down RESPA, I want you to underline the word settlement. Settlement means closing. So settlement means we're at the closing table. And the two institutions at the closing table with us are the mortgage company and the title company. So RESPA has a special place in the regulation of title companies and mortgage companies, because those are considered settlement activities. RESPA applies to residential transactions designed to reduce the cost of closing by not allowing kickbacks from title companies or mortgage companies to real estate agents. A real estate licensee who accepts a fee for referring a buyer or seller to a specific title company would be in violation of RESPA. So the real estate licensee who accepts a fee or a kickback for referring a buyer or seller to a specific title company or a lender would be in violation of RESPA.
Okay.
And so would the mortgage company, so would the title company. So we have a risk here as a real estate licensee that we cannot take money from title companies and mortgage companies. What is the difference between a face-to-face closing and an escrow closing? In Colorado, face-to-face closing is when the buyer and seller meet at specified place to sign closing documents. After the seller and buyer have signed all necessary paperwork, seller signs the deed and delivers it to the buyer who accepts it. Seller's mortgage is paid off and satisfaction of mortgage is recorded, and then the seller's deed to the buyer is recorded. Buyer provides sales price to the seller. At an escrow closing, a third party coordinates the closing activities on behalf of the buyer and the seller as soon as the property goes under contract, and escrow instructions are delivered to the escrow company. All pertinent documents are sent to the escrow company before the date of closing. When title is determined to be marketable and all other conditions to close are met, the escrow agent disperses the sales price minus fees and records the deed. Colorado is a face-to-face closing, and some other states have escrow closings.
So does that mean that any time that there is a sale of a property, the buyer and seller must meet face to face?
No, they don't must meet. It just means it's more tradition.
Okay.
And it also means that it's still gonna happen as if they were there, even if they're not there. It's still gonna happen at that designated time and place.
Okay, so all the paperwork has been signed,
Yes.
and you literally just give a power of attorney to someone to actually complete the transaction.
That's one way to do it. Or another way to do it is if the buyer and seller are not getting along for whatever reason, we could have the seller come in, we could have the buyer come in at 9 and the seller come in at 9:45. And then the transfer happens at 9:45.
Okay.
There are 3 things that the Real Estate Settlement Procedure Act prohibits. 1, kickbacks for referrals of settlement services, meaning mortgage and title. Home sellers from requiring the buyer that the buyer purchase title insurance from a specific company. Okay, we can't require. That's a negotiated item in the contract. Lenders from requiring excessive escrows for taxes and insurance. So lenders have an escrow account for the buyer's property taxes and homeowners insurance. They cannot require an excessive escrow amount. They can't require the buyer to put way more in there than what they should have. An affiliated business arrangement is what you were talking about earlier, Tim. An affiliated business arrangement is a way for real estate firms, title companies, and mortgage companies to streamline the settlement process by offering a specialized package of services. RESPA allows for ABA systems to be in place if certain measures are taken, such as disclosure to consumers is critically important. So disclose, disclose, disclose. What is the loan estimate form and what documents does it replace? So this question goes back to 2008 when things really got really wonky. So it is prepared, the loan estimate form is prepared by the lender for the borrower at the beginning of the loan process. Must be provided to the borrower within 3 days after the loan application is submitted to the lender. So the loan estimate form is provided by the lender to the borrower at the beginning within 3 days. Contains certain It contains information on loan interest rate, monthly payments, and total closing costs. It replaces the truth of lending and the good faith estimate. What is the closing disclosure form and what documents does it replace? So this is part B to 106 really. It's prepared by the lender for the borrower and presented right before closing. So this is at the end of the process. Must be provided to the borrower 3 days before closing. So now the borrower gets to see the numbers 3 days before closing instead of just showing up and seeing the numbers for the first time. It contains detailed information on taxes and insurance and warns the consumer to avoid prepayment penalties because they're likely to be predatory lending. It replaces the truth in lending statement and the HUD-1 settlement statement. What's the difference between a debit and a credit, Tim?
If it's a card, one comes straight out of your bank account, and the other one basically you pay for it later.
Okay, that's true. That's true. So the way we're going to look at it is in accounting terms, and we're going to call a debit is the amount to be paid, and a credit is the amount payable.
Yep.
Is the amount received, is the amount you receive. So think about debit as something you owe and credit something you receive.
Yep.
So debit is the amount to be paid by the buyer to the seller. Credit is the amount payable to the buyer or the seller. Payable to versus paid by.
Yep.
So if there's a buyer, so we'll get to it. So these are expenses. So typically the seller pays the commission. So we have the broker's commission is typically paid by the seller. So this would be seller debit.
Yes.
Attorney's fees. We could have buyer paying some attorney's fees and seller paying attorney's fees. So that would be debit buyer, debit seller. Recording fees. We could have some recording fees that benefit the buyer, so that'd be debit buyer, and we could have some recording fees that benefit the seller, so we could have debit seller. Transfer tax, debit buyer, debit seller. Title insurance. Typically, title insurance to protect the buyer is a debit by the seller. Loan fees are typically buyer's expenses, so those are going to be buyer's debits. Tax reserves are going to be a buyer debit. Appraisal is typically a buyer cost or a buyer debit. And the survey is frequently a buyer cost or a buyer debit. So when the buyer has a cost, it's a debit. When the seller has a cost, it's a debit. When the buyer receives money, that's a buyer credit. When the seller receives money, that's a seller credit. Okay. So sales price. So if who pays money and who receives money?
It would be debited.
What's that?
The buyer is debited and the seller is credited.
Exactly. So since the seller receives the purchase price is a credit to the seller. Since the buyer is paying the purchase price is a debit to the buyer. So credit seller 500,000, debit buyer 500,000. Okay? It's important to know that the debit and the credit amount is always the same amount. Okay?
Yeah.
Okay, they can never be two different amounts because it just shows the transfer of money from one person to another person. So it always has to be the same amount of money. Money can't disappear. Okay, what is the credit debit entry for a loan payoff? So now we're talking about the seller's loan. Okay.
So for the seller, it would be a debit, and it would be a credit to the mortgage company, the lender.
Right. So it's a debit to the seller because the seller is paying off their mortgage. So the seller's paying off their mortgage. That's why it's a debit to the seller. Now it's a credit to the broker or the closing company. And what they do is they receive the money and they give it to the seller's lender. The broker sits in for all third parties. So there's only 6 columns. There's a buyer, debit, credit column, that's 2. There's a seller, debit, credit columns, that's 2 more. And then there's broker, debit, credit, and that makes for the 6 columns total. Does that make sense?
Yep.
Okay. All third parties are represented by the broker. And the broker, which is the listing broker, is responsible for getting that money to or from the third parties, because we're responsible for that closing. And that's why we represent that debit and credit as the broker, okay? And as a matter of law, we have responsibility for that closing to make sure all that money's coming in and out appropriately. And so fortunately, we work with really good title companies who do this all day long, and they really do this for us. And we just pay them a little fee to do it for us. But we still retain the responsibility of it. Who owns the property on the day of closing? Now, this is in the national section, so that's different than the Colorado section. Go ahead.
It would be the seller in the national that owns the property on the day of closing.
That's right. On the national side of the exam, the seller owns the property on the day of closing. Now that's important for us as we figure out the prorations, because then it's the seller who's paying property taxes on this day. The buyer doesn't have to pay property taxes on the day of closing because the seller's responsible for property taxes on the day of closing. The homeowners association fee, the seller is responsible for the homeowners association fee on that day. Does that make sense?
Yep.
Okay. When prorating expenses or income, how many days do you count in a year and in a month on the national side?
360 and 30.
Yep. On the national side, we pretend the year has 360 days in it, and we pretend every month has 30 days. So what I want to share with you, Tim, is there are no national closings. Every closing happens in a state. This whole section is just to help us understand how to prorate. And so we pretend like we're living in a world that has 360 days in a year, and every month is 30 days on the national side. So it's just for the purpose of practicing prorations that we have this on the national side. When we do the same thing on the Colorado side, we'll use the exact number of days in the year and the exact number of days in the month.
Okay.
Is mortgage interest paid in advance or in arrears? So
Arrears.
This is a pretty, what's that?
Arrears.
Yeah. Arrears. So February 1st payment covers January's interest. Okay. So when you make your mortgage payment on February 1st, you're actually paying January's interest. But Tim, guess what? You're paying February's principal. So that's really funny. It's weird how that is, but that's true. What are the differences between accrued items and prepaid items, Tim?
I read this earlier. Got off the top of my head, accrued items are expenses to be prorated.
Okay, they both are.
Are expenses to be prorated.
Okay.
Sorry. Okay, so accrued is such as water bills and interest on assumed mortgage.
Okay.
Prepaid is on things that have been brought onto the property, such as fuel.
Good.
Oil in the tank.
Okay, and the thing to remember here is accrued are to be paid later, and prepaid are paid in advance. So accrued are to be paid later, like property taxes. We're incurring 2020 property taxes now, but they won't be paid till 2021.
Yep.
Whereas homeowners insurance is always paid in advance. So all of 2020 homeowners insurance was paid at the beginning of the year. So when we prorate that, the seller is going to get some of that back because they paid for the whole year. Okay, how do we calculate a proration? Well, first of all, we determine who owes whom money. So start there. Who's going to owe who money? Is the seller going to owe the buyer, or is the buyer going to owe the seller?
The buyer is going to owe the seller.
Yeah, figure that out first. And it's going to vary depending on whether it's an accrued item or a prorated item. If it's an accrued item, then the seller is going to owe the buyer. If it's a prorated item, then it's the buyer who's going to owe the seller. Okay, so if this, okay, the second thing to determine is determine the amount per day. So if we're figuring out property taxes, figuring out how many days, how much it was, and figure out how much it is per day. Then determine the number of days in question. And then multiply number 2 by number 3, and then create your debit and credit statement. So that's how I like to think of it. And Tim, don't go too fast. Make sure you do step number 1 first.
Yep.
So you don't get yourself confused. I always purposely go slow on step number 1 because that's going to eliminate half the answers. Okay. And I also want to make sure in my mind I know who owes who money. Identify the yearly charge, divide by 12 for monthly charge, or divide by 360 for a daily rate. Then multiply the number of days or months in a prorated period. Okay, prepaid bill for June was $113, sold on June 11th. So what is the proration? So there was a monthly bill in June, and that monthly bill is $113, okay? And first thing, what's your answer to question number 1 in your steps, Tim? Who owes who money?
God, I've got the final answer.
No, I want to know who owes who money.
Okay, so prepaid bill for June is by the seller. If the seller sells the house in June,
On June 11th.
On June the 11th, it's going to be the seller should be getting a credit.
Good. Sellers due money. So buyer owes, seller receives. Buyer owes the seller money. Do you agree?
Yep.
Okay. If the buyer owes, is that a buyer debit or a buyer credit?
It is a buyer debit.
Good. If the seller receives, is that a seller debit or a seller credit?
Seller credits.
Good. Okay.
Of $41.43.
Oh, you got, Let's see what happened here. So we have $113
divided by 30.
Divided by 30, and we got roughly $3.77 per day.
Yep.
And the seller prepaid. So the seller, so the buyer, so let's see here. Buyer owes for the 12th through the 30th, right?
Yep.
So they owe for 19 days. 377 times 19 days, $71. This is so easy to mess up.
Oh, see, I've got 71.56.
Okay, that's close enough. Your rounding was better than mine, so you're good.
Okay.
Do we prorate tenant security deposits?
Yes.
No. So in this situation, here's what the question means, Tim. Let me just provide more context because those 6 words don't provide a lot of context. the question is asking, the buyer is buying, let's say, a fourplex from the seller. And each unit has a security deposit being held by the seller.
Right.
Okay? So when we say prorate, we mean set a pro daily amount, a pro rata amount. No, we transfer the entire amount from the seller to the buyer. So it's going to be seller debit entire security deposits, buyer credit entire security deposits.
Right.
And then when the tenants, and then the property transfers with the deed, and then when the tenants eventually move out, the new owner has to get right with the security deposits.
Yep, so it's a debit for the landlord and a credit for the tenant.
Okay. Okay. A prospective buyer needs to borrow money to buy a house. The buyer applies for and obtains a real estate loan from a mortgage company. Then the buyer signs a note and a mortgage. In this example, the buyer is called the
mortgagor.
Yep. We didn't talk about capitalization rate in our questions, but we will later. There's a couple of questions here I need to shift to another thing.
8%.
Do you know what, yeah, go ahead and look at it. See if you could just deduce it.
That's 8%.
Very good. This is about as hard as the math gets, Tim. So I think that's great. You got it.
I love math, so this is nice and easy for me.
Good. And here are the formulas just for you to remember. But capitalization rate's as hard as it gets for math. The provisions of Regulation Z require all the following to be disclosed to the residential buyer except?
Okay, Regulation Z is where you're not allowed to receive kickbacks.
That's RESPA.
That RESPA. Okay, Regulation Z, look up more.
Regulation Z is what backs up TILA, Truth in Lending Act.
Require all of the following to be disclosed to a residential buyer. Well, the buyer's going to know what the loan interest rate is. They're going to know what the loan origination fee is. You should be telling them what your commissions are. So I would say discount points.
No. So the provision of Regulation Z requires all the following to be disclosed to the residential buyer except for brokerage commissions. Brokerage is the real estate brokerage is what it's talking about here. Whereas these three things are all part of the loan, and TILA is all about the loan. So this was just, so just keep in your mind separate mortgage stuff from real estate stuff. This is really like the seller's commission, what they're paying. It doesn't have anything to do with Regulation Z. So know that brokerage means it's real estate brokerage.
Okay.
Oh, here's a really tough question. Almost no one gets this right, although I wish they would. All the following factors would be important in comparing properties under the sales comparison approach to value except. The sales comparison approach, which we didn't cover earlier, we'll cover later, is one of the three approaches appraisers use to value property. So if you were an appraiser and you're valuing property, three of these things you would consider and one you would not.
Well, I wouldn't consider the differences in financing terms because that's got nothing at all to do with how much the property is worth. That's just a market condition for borrowing the money.
Okay, I'm going to stop you there because actually that is something they consider because they want to make sure. No, your thinking was right on, Tim, and but it was good, solid thinking, but it's not right.
Okay.
they consider it because they want to make sure it's an arm's length transaction. Because if I sell you my house at 1% interest rate, you would pay more for my house.
Right.
So that's why it matters. But your thinking was right on, but they do consider that. So keep going.
Okay, so all of the following factors would be important in comparing properties under the sales comparison approach to value except. So the differences in dates of sale are basically showing you the fluidity of the market in that area. So that could be a sign of supply and demand. So that's differences in financing terms, as you just explained, are important. Appearances and condition, that's important because if the property is all run down and falling apart, you wouldn't want to, you'd basically be devaluing it. So that's important. And the original cost, I presume that was the original build cost.
Right.
That would have been consistent across, fairly consistent across the board if all the properties were similar.
Yep. So this is the one that doesn't matter because what someone paid for it a year ago or 5 years ago or 10 years ago doesn't matter to today's market. So the appraiser is evaluating the value of the property today. They don't care what you paid for it yesterday. They don't care if you overpaid or underpaid. That's not part of their evaluation at all.
Right.
So they only care about what's going on in the market. You know, what in the last, was this home sold today or 10 days ago, and how has the market changed? The financing terms, was it an arm's length transaction? Or was there some sort of crazy inducement like discount points that allowed the buyer to pay more for the property than it was worth? So that counts. And obviously, is it run down or not? What's the condition? That counts. What they don't care about is the original cost.
Okay.
Legal title always passes from the seller to the buyer.
When delivered and accepted.
What?
D, when deed is delivered and accepted.
Thank you. Good. The annual homeowners association fee on a property amount of $1,800. Okay. The seller has paid the HO fee in advance for the year. If the closing is June 15th, which statement is true? So first things first, who owes who money? Does the seller owe the buyer or does the buyer owe the seller?
The buyer would owe the seller.
Okay, so if the buyer owes the seller, is that a seller credit or a seller debit?
It would be a seller credit,
Good.
buyer debits.
Okay, seller credit, buyer debit. Okay. Question letter A, is letter A possible?
Oh, sorry.
Is letter, I know, thanks, I know you want to get the answer, but I just want to have fun with this. Is letter A possible?
So, sorry, let me just read it again.
Okay, sure.
Which statement is true? So it would be a credit to the buyer. Sorry. The seller has already paid it, so it would be a credit to the seller and a debit to the buyer. So that could possibly be true.
Let me try again. Why couldn't letter A be true?
What, 825, and so it's basically June the 15th is prior to the halfway point in the year, at which point
is 825 the same amount as 975?
Nope.
Then it can't be true. Remember, the debit and the credit have to be the same amount of money.
Oh, yep, sorry, I'm with you.
Cool. So that's why A cannot be true, because the debit and the credit, we're just transferring money between two people, and it's got to be the same amount of money.
Yep,
Okay. So that's why A cannot be true.
which means
Can
B
B be true?
Yeah. No,
What?
no, B can't be true.
Nope, B can't be true because it's not the same amount of money. Can C be true?
Well, it's a credit to the seller, so C can't be true, so it must be D.
Exactly.
I've
So
got to
that's-
remember my T accountings.
Yeah. And so just remember, all the debits and credits have to be the same amount of money, and that will help you get rid of some things.
Yep.
And it'll also help keep your thinking straight, so you don't get to something like this, which is really easy to do.
Okay.
Okay. Your mind's going to want to do that. Don't let it. Okay. Good. Okay, sir. Any questions before we close for the night?
I don't think so. I think that I've asked the questions that I wanted. Because that can't happen. No, I'm good. Thank you very much.
Good, Tim. Have a good evening. It was good to work with you.
And yourself. Thank you very much. Cheers, Todd.
Take care.